Welcome back to Financial Clarity for Doctors, everyone. This is Rachelle Vanderzanden here with Corey Janoff.
Hello.
Hello. So, today we're going to talk about a thing. You probably saw the title of this podcast episode, which is going to be something about how property values may be declining. Don't freak out. That's not the intention of this episode. I think it's also one of those things where it's going to be very case by case, depending on where you live. It like your property value, if you own a home, may or may not be down. Who knows? Not trying to cause alarm here. We just wanted to talk a little bit about when the housing market slows. What does that look like? What could be some potential problems if you're trying to borrow money or refinance or things like that? And also, how you may be able to deal with those problems. So we're going to go through some case by case things and then talk through it. But I think, one of the biggest things with financial planning is that if there's a thing you can't control, probably doesn't make too much sense to worry about it a lot. So we're going to talk a little bit about the things that you can control and then move on. And that's all you can really do.
Some good life advice too, not just
Yeah,
financial planning.
we're so good at life advice.
hmm Yeah, if you can't control it, worrying's not going to help.
Mm-mm.
But yeah, real estate, I think we've mentioned before and most of you are aware, it's very local, location. Like the
Mm-hmm.
prices of properties vary and price changes vary drastically from state to county to city to neighborhood to street to
Mm-hmm.
which side of the street you're on. Like, are you on the side that backs up to a busy road or on the other side that backs up to a forest? Like it really is house by house. So
Mm-hmm.
your house might be up in value, your neighbor's house might be down in value, the house across town might be way up or way down. Like it really varies. Um, but today we want to talk about if you are potentially seeing your property value decline or maybe even underwater in your mortgage, meaning your mortgage is greater than what you could sell your home for. Not a good feeling. So, hypothetically, let's say you bought your home for 1 million and a year later it's only worth 900,000 or 2 years later, 3 years later, whatever. But you paid 1 million, now it's worth 900,000. And not everywhere, but there are some major markets where that is the case. I think you can do some Googling and the sources will vary, but according to the Zillow Home Price Index, values have decreased double digits from their 2022 peaks in some of the larger markets. In many markets, home values have increased since then, just definitely at a slower pace than the
Mm-hmm.
first couple of years of the 2020s. But for example, Oakland and Austin, so Oakland, California, Austin, Texas, have seen 24% declines in home values. New Orleans has seen an 18% decline, 13% for Fort Myers, 12% for DC, 10% for Denver, Portland, Phoenix. And again, this is just Zillow home price averages in the city as a whole. So one side of town might be different than the other side of town. Um, and but still, like, it doesn't feel good if you bought a place in Oakland or Austin and you paid 1 million and now it's worth 760,000. That doesn't feel good.
Rough.
Yeah,
Mm-hmm.
especially if you were in a physician home loan where you only put 5 or 10% down. So now your mortgage is 900,000, but home value is 760. Um, if you sold it, you'd have to pay money to pay off the balance. If you can't refinance unless you paid down a 250,000 to get it into that 80% loan to value ratio. You can't take a home equity line of credit. So there are some negatives there. But if you're planning to stay in this home for a long period of time and you don't need a home equity line of credit, whatever, who cares? Doesn't matter. You've got a roof over
Especially
your
if you
head.
bought like 2022 or earlier, because chances are you're in a mortgage where the interest rate's decent. So if that's the case and you're planning to stay for a while, you're probably fine. And honestly, you're probably paying less monthly than maybe you would pay for that house currently if you bought it because your interest rate is so low. So there's like positives and negatives to all of this kind of stuff. But yeah, I
Yeah,
think if
go
yeah,
ahead.
if you bought your house before 2020, it's unlikely that this has affected you too much. Like obviously your property value may have declined since it its magical Zillow estimate in 2022 that didn't matter at the time because you weren't planning to sell it at the time. It may be worth less than it was at that point. But again, it doesn't matter too much unless you're going to try to sell it. And even if you are, like if you're trying to sell a home and purchase a new home, that's like an upgrade, you're getting a great deal on that new home also. So it doesn't matter that you're not going to earn quite as much on the home that you're selling. So there's lots of pros and cons to this.
For sure. And yeah, I mean, the
Yeah.
price declines, it's not, and underwater mortgages, it's not as crazy as it was in 2008 to 2011, where some markets saw 50% declines and people were doing 0% down loans, interest only, balloon payments. Like, then
Hmm.
your mortgage is the same value as what you paid for the home, and your home is worth half. I mean, that's where people just walked away and foreclosed. They're like, it's not worth it. Just take my house. It's,
Hmm.
worth less than it would cost me to get out of this mortgage.
Yeah.
And that really, yeah, affected banks adversely. But this is just, I would say, in the grand scheme of things, minor inconveniences for a small subset of the population. I guess a major inconvenience for a select few, but for most of
Hmm.
you, doesn't affect you at all. But
Yeah.
let's talk about, the things that could potentially affect, like refinancing your mortgage. Like if you bought a home 2023, fall of 2022 at a 6.5, 7%, 7.5% interest rate, and now you want to refinance it to potentially under 6%. If your home's worth less, that might be challenging.
Yeah. Yeah, so I think it's hard because when you buy a home and interest rates are somewhat high, I think the real estate agents of the world and the mortgage brokers of the world are often like, "Hey, date the rate and, buy the house." It's like that whole thing where they're like, "Hey, your interest rate is potentially temporary. You can refinance in the future when rates go down, your payment will come down, you'll be in a lot more comfortable position." But refinancing isn't necessarily a given when rates go down. You have to be able to qualify for the refinance. So if you don't have enough home equity, which sometimes like banks will require 20% home equity in order to be able to refinance a loan. So if you don't have 20% equity, you may not be able to do that. So if your house is worth $1 million and your loan value is only 800,000, you're fine. But if you bought that $1 million home and you financed 90% of it, so your mortgage is $900,000 and now it's only worth 800,000, they're not going to let you refinance. They're not going to let you do that and bring down the rate unless you are willing to pay a chunk of money to get that loan to value ratio where it needs to be. That probably doesn't make sense for most people to come up with that lump sum of cash, but do the math because as always, it depends. If you need to pay 50 grand, but your mortgage is huge and you're going to save, 50 grand or more on interest per year, maybe it does make sense to do that. So do that math for yourself. Like obviously, lenders and things like that will help you with that, but they are incentivized to have you do things like refinance. So keep that in mind too. Like they make money when they close on a new loan, which a refinance is often a new loan. So keep that in mind, do your own math, double check everything. If you are buying a new home, I think it's really important to clarify exactly what is required of you in order to refinance. So if you're planning to do that in the future, what does that look like with your current bank? Like, what would the cost be to refinance? What would the equity requirements be? Like, how much does your loan to value ratio need to be? When it comes to time to kind of decide that, what is your equity? Do they require that you have an appraisal? Or will they base it on what the purchase price was? Like what are they willing to use as your home value? And that's a big thing as well because I this whole thing came up because I was talking to clients and they tried to refinance and it was a home that they'd bought for more than $900,000 and they did an appraisal to try to do the refinance and their loan or their home value came back at 800,000 and they'd put 20% down on their house, but now they do not have 20% equity, so they weren't able to refinance. So they're stuck with that higher interest rate for longer.
And there, with a purchase, like there's loans out there where you can do a minimal amount down. Like some lenders on certain types of homes and loans will do 0% down. Typical physician mortgages, you do 5 to 10% for under $1 million or $1.5 million. Once you get to that seven-figure balance, you often need 10 to 15% for those physician home loans. But in that previous example where you bought it for $1 million and now it's only worth 800,000, but the mortgage is 9, even if you put 20% down, mortgage is 800,000, but your home value dropped by 10% to where it's only 900,000. You still have equity, but you probably can't refinance because most refinances require a 20% equity or 80% loan to value ceiling. So on a new purchase, they'll stretch the rules a little bit. And even on a conventional loan, like you could, even non-physician loan could get a home with 10% down, but you typically can't refinance unless you have 20% equity. There might be some exceptions out there with certain lenders, but yeah, even if the home's worth 900,000 and the mortgage is 800, you might need to put 80 grand down to refinance, which might not make it worthwhile.
Hmm. Yeah. I think with this, you may just be stuck with that higher payment for longer, period. And it's not the end of the world. Like hopefully when you bought the home, it was like doable to make that mortgage payment because that's what your mortgage payment was. So in the future, like you may be able to refinance as property values start to return or as you're starting to pay down the equity and things or like pay down the principal balance. So it's worth reconsidering in the future, but it may just not be in the cards in the short term.
Another one, home equity loan or home equity line of credit. A lot of people are sitting there on thinking, yeah, it'd be nice to have a slightly bigger home, but buying a new home would be more expensive. And I don't know if we could sell this one, but maybe we could like knock out this wall, build an addition, yada, yada, yada. Spend a couple 100,000 doing some renovations to make the home more livable for our needs. Let's look into taking out a home equity line of credit where you basically borrow money against your home value and you get a much more favorable interest rate than if you just did an unsecured personal loan or credit card. Because if you don't repay the loan, they could take your house from you. So there's an asset there of value that they could seize that you're putting up as collateral. So typically, home equity lines of credit are tied to the prime interest rate. So you're going to have right now probably around as of this recording, it'd be around a 7% interest rate, give or take. But that's going to change as time goes on. If you listen to this a year from now, it could be more, could be less, who knows. But yeah, a lot better than a credit card or unsecured personal loan that are probably going to be double digit interest rates. Problem is, if you don't have enough home value, you can't take out a line of credit. Typically, going back to that 80-20 rule, the maximum amount most lenders will let you have outstanding against your home is about 80%. Some will go up to 85%, but if your mortgage takes up 80% of your home value, well, you can't take out a
Or
line of
more.
credit. If your mortgage is only 30% of your home value, great. You could take out a pretty sizable line of credit against your home. But yeah, so that could be an option that's not an option for people is a home equity line of credit. So that renovation might have to be on pause or you'll have to find other ways to potentially pay for it rather than taking out home equity.
Yep. For smaller projects, it may be possible to do some sort of short-term solution like 0% financing on the new HVAC unit or a 0% interest rate credit card. A lot of times you can get some pretty high balances on those, especially if you're a high income earner. Like banks are willing to lend you quite a bit at a non-existent interest rate, but that will be very temporary. Maybe 12, 15, maybe 24 months at the very most. So you have to be prepared to pay that off pretty quickly. So that's something to keep in mind. But there's lots of options like that out there for at least smaller projects, like maybe even up to 20 grand or 30 grand. Like I have clients who have 30 grand on 0% interest rate cards because they were doing home improvement projects and that was the best way they had to finance them. And now they're just working on paying them off over the next couple of years and they have plenty of income to do that safely. So it's a fine. It's a good strategy to use for the short term. It's just not something we want to be doing on a regular basis. And it's also not going to cover a home addition or probably a kitchen remodel or anything big like that. It's going to be very limited in terms of how much money you have available to do things like that.
It's total side tangent here that's
Yeah,
unrelated. But we like to get sidetracked. So FedEx
we
just
do.
came and delivered a package, and I see the guy at my office is right at the front corner of our house, and I see the FedEx guy jump out of the van like a kid jumping off a swing, grab the box, jog up it's not a far way, but from the sidewalk to our front patio and looked like he was bowling and just slid the package from the grass to our doorstep. So
I love
hopefully
it.
there's nothing fragile in there and it's just clothes or something. Um,
And that was very efficient
but
of him.
it was a very efficient delivery. 1 out of 5 stars on the care of handling the package. It looked like the luggage guys at the airport just chucking it onto the
Oh my
conveyor
gosh.
belt.
Yep,
So,
it happens.
anyways, real estate.
Real estate, yeah. I think maybe the toughest spot you may be in is if you want to sell. Like that's going to be hard, especially if you bought somewhat recently or in that 2020 to 22 price range and your home value is just less than maybe even you bought the house for, or maybe it's even less than their mortgage balance. And it's going to be hard to get out of that house in a way that's like financially beneficial. But sometimes it's not always about the money. Sometimes it's we're moving to 4 states away and it makes sense for us to get rid of this house and buy a different house. And we're willing to pay money to get out of this because if your sale value is just not enough to cover that principal balance, basically pay off the bank, pay all the closing fees to the real estate agent or whoever else has to get those closing fees, then that's what's going to happen. You're going to have to come up with a chunk of money in cash. I think in that like 2008 to 2011 timeframe, you saw a lot of people just like holding on to properties as rentals, and that could be a good short-term solution potentially, or maybe even a long-term solution if it ends up being a good rental. But if you hold on to that house and you can charge enough rent to kind of cover your expenses and then just kind of let it sit and maybe recover its value a little bit before you sell it, that could be a good option. Obviously, you're not going to be able to get equity out of that house to put toward your next home down payment. Like that's not happening. That's kind of what we hope will happen moving forward when we're doing, sales of our current home to get into that next home, but it's not always going to happen just depending on where the real estate market is at. Um, so, I mean, there's a couple of different things you can do. You can also just sit tight. Maybe it's just not time for the upgrade. Maybe it's time to sit in your current home and be happy with what you have currently. But obviously, it always depends on what your current situation is. And again, it's not always about the money. Sometimes it makes sense to do the thing that's maybe not the most financially beneficial because it's the thing that you need to do.
Yeah, and I really encourage you to ignore what you paid for the house when you're going to sell it, because that can sometimes be a sticking point that gets in the way of you making the appropriate or best optimal financial decision for you and your family moving forward. It's like, hey, we bought this house for $1 million. I don't want to take a loss on it. So I really want to sell it for more than $1 million. Otherwise, it's not worth it to me to sell. It's like, well, no, with all of these factors in your move, your new place, whatever, blah, 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 it makes a ton of sense for you to sell this because you could only rent it and get half of what you're paying in your mortgage. Like
Yeah.
you're just going to be hemorrhaging money. Take the loss, move on, just be done. Like that's a sunk cost. You're not getting it back. So ignore what you paid when you're going to purchase. Just focus on what the market is offering now and get the most that you can. And sorry, when FedEx sidetracked me, did you already go through this like example here of, I don't know if you can see my highlights,
No.
but
Mm-mm.
so yeah, I
Nope.
mean, it's, if you have to, um, even if you have to pay a little bit of money to get out in some cases, like not
Mm-hmm.
ideal, but for example, let's say you can sell your home for $1 million, but your mortgage is 950,000 currently. Well, all right, we've got a little bit of equity, 50,000, so maybe we can break even, but in reality, it's probably going to cost you a little bit because you're going to pay an agent commission of around 60,000 to get out
Yep.
of it. You're going to have to pay a seller portion of the closing costs. Let's call it 10,000. Could be more, could be less, who knows. Um, so now, 70,000 of just fees, 50,000 of equity. It's going to cost you $20,000 to sell your house. You're not getting any money. You're paying money to sell that house, but in the grand scheme of things, that might be worth it. And, because if you were to hold on to it as a rental and you're losing 3 grand a month in, because you're not able to rent it for as much as it costs you. Well, it's probably, after 7 months, you're now, that's more than $20,000 lost. So it
Yeah.
probably makes sense just to pay the 20 grand and move on, clean slate.
Yep.
You're not getting that money back. So
It's another
it's
one of those do the math examples. Like, okay, like every circumstance is different. So it's not going to be a one size fits all solution for everybody.
for sure. Yeah.
Yeah.
Um, let's see.
Yeah. I guess going back to the original thought, but there's, yeah, no use stressing about the things you can't control. That is what it is.
For sure. Yeah, look it forward, hey, forget the past. And you could do this with your investments too. Like, hey, I bought this stock at $100 a share, or I put $10,000 into it and it's worth 8,000. And I really, I don't like this position anymore, but I also don't want to take a loss because then I feel like I failed or I lost the
Yeah.
game or whatever. I'm admitting defeat. But I think it's another Carl Richards um whatever you want to call it, but I've heard him talk about do the overnight test where, if you were given cash instead of the investment, would you use your cash to buy that investment or would you do something else with the cash? So in this example, if you had $8,000 cash, would you go buy that stock with the 8,000 or would you do something else? Well, you'd probably go do something else with it. All right, great, cut your losses, sell it, do something else with the money that you think is more optimal for your financial circumstances. So, forget about what you paid for something. The market doesn't care what you paid. The market only cares about what the equilibrium value is that, where the demand meets the supply and what buyers and sellers are willing to agree on for a price. Um, you might not be able to get what you paid for it, and that's okay, but it doesn't necessarily make sense to dig your heels in and hang on until you can get back to even, because that potentially could cost you a lot more than if you just cut your losses and moved on at this point in time. So yeah,
Hmm.
again, it's a do the math equation, take the emotion out of it as hard as it is, but it's purely let's run the numbers and see what makes the most sense for you financially. And if we have to take a little bit of a haircut in the grand scheme of things, it's still probably best for you than just hemorrhaging money over the next few years, hoping that things will rebound and you could potentially sell it for more in the future. But that's not guaranteed either.
Hmm. Yep. Just a few takeaways. I think this is one we talk about a lot, but if you can plan to own a home for at least 5 years, that not eliminates, but reduces a lot of this risk that we might be like underwater because it gives you time to recover from any sort of corrections. It also gives you some time to kind of adjust for those transaction costs on the front end and the back end when you're selling the house. Like if you have more time to potentially build equity in a house and like ride out any corrections in the housing market, then, you have a better chance of being able to pay the real estate agent and not go underwater and all of those kinds of things too. It's really hard to count on those kinds of things if you're going to own a house for less than 5 years. So we generally discourage people from doing that. And honestly, like the longer you can stay in a home, the better that transaction usually is for you. And then a couple of things that we've already talked about a little bit, like don't listen to real estate agents and mortgage brokers when they're being overly optimistic. You don't know if they're being overly optimistic, but generally just realize that they have biases just like everybody else. And
They're
their bias
incentivized to
they
be
are literally
optimistic.
paid when you buy or sell a house, when you close on a loan. That is how they are paid. So there's almost no way for them to be unbiased if you think about it. Like they can't. Their brain is hardwired to like earn an income. So they are going to be optimistic. So just keep that in mind. It doesn't mean that they're wrong necessarily. It just means that maybe they are going to look at this in a very like through some rose-colored glasses. They're not going to necessarily see some of the risks or they're going to minimize some of the risks. Like what if the housing market goes down and things like that. So I think if you give real estate long enough, it has generally gone up, but in the short term, it may go up or down. And so that's a risk that you need to be prepared for, just like with investments, just like with any other sort of transaction like that. Like it can go both directions. And I think long-term real estate can be like a very beneficial holding, but in the short term, it may or may not be. So just like with everything else, when you're making a big purchase like that, when you're investing money, like there's always some risk associated with it.
But even long term, residential real estate, it isn't this end all be all best investment ever. Like
Yeah.
it's historically residential real estate, and this is just nationwide. Obviously, every city is a little different and it has growth spurts and drawdowns, but real estate appreciates in line with inflation, maybe a hair more than inflation. Obviously, in recent years, it spiked a bit, but we're seeing that level out and even come down in a lot of markets as of late. And when you factor in the transaction costs, the mortgage interest, the property taxes, the maintenance expenses, and you actually do the math, like you're lucky if you can get out what you put in to your house, which is a terrible investment. If you put in $2 million over the lifespan of owning your home and you can sell it for 2 million, like that's you lost money after inflation has been factored in. You would have been better off just putting it in a CD from a pure investment standpoint. But you need a place to live. You need a roof over your head.
Uh-huh.
That scenario where you're getting your money back and quote unquote breaking even is way better than renting over the long run. So I'm still a big fan of home ownership over the long run. It's kind of a forced savings vehicle
Yeah.
as you pay down your mortgage and the home value hopefully appreciates in line with inflation. You have a valuable asset. And for most all of you, it's going to be a seven-figure asset to your name that is immensely valuable. You can tap into home equity. You could do a reverse mortgage in your golden years. You could sell it to pay for the nursing home when you're in your 90s. Like so many
Mm-hmm.
options. We're big fans of owning real estate over the long run, but don't kid yourself. Buying a primary residence is not an investment. It's an expense, but you need a place to live. It's probably a better expense than renting for your entire life. Not always, if we
Yeah.
do some
And
math
and
in
in the
some
short term, it
markets.
may not be the better option.
Yeah, short term it may not be, but like if you can rent a
Yeah.
place for 3 grand a month or buy a place and the mortgage and everything is 15 grand a month, well, all right, that math isn't
Doesn't
is
pencil.
yeah, isn't as favorable. But yeah, over the long run, big fans of owning real estate, but it's not a great investment for investment purposes. So that's where we don't want to overextend ourselves on a house. We need a place to
Hmm.
live. We want it to be comfortable, want to make it our own, ideal for the family, etc. Um, but we want it to be within our means as well and something that we can afford the payments, even if we have to stay in the house a little bit longer than we originally hoped or planned to be in there for.
Yeah. I think bottom line, if you're in a home and you stare at the Zillow value every once in a while and your home has decreased in value on paper in this magical internet world, but you're not planning to sell it or refinance or do anything about it, like stop stressing about it. Who cares? Like it doesn't matter at that point until you're trying to sell it or you're trying to borrow against the value. Like if you're not, it doesn't matter. Like you're still paying whatever you're paying for your mortgage, you still have a roof over your head, you're like your house, you're in a good spot, you're fine. So what matters most is the value when you try to sell it. But again, that may not matter as much as you think, especially if you're upgrading, because if real estate values have come down, it also means the new house that you're getting into may be less expensive than you otherwise would have paid. So there are some limited circumstances where this could be a little bit painful, especially if you're wanting to refinance and things like that. But in general, like enjoy the roof over your head. It is what it is. You bought it because you liked it, hopefully. And it's all good. Like all of these problems can be dealt with. Like we can find a solution to them.
Yep, yep. Well, thanks for listening as always. And we'll see you next time.